Well, hey there, everyone. Happy Thursday, October 30th, 2025. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a perfectly perfect fall day here in Redmond, Washington. I sent my parents the weather report here in the area. Pretty much calls for rain the next 10 days. I expect that to continue through early May of 2026. Having said that, the market rolling over, experiencing its own rainy day here on Thursday, October 30th. I've threatened to play trumpet on the show if and when the S&P closes above 7,000. I had a number of calls for that happening this week. Not to be the case, at least today. We'll see if there's a huge upside reversal tomorrow, but looks like I got a couple more days to work up the chops and get ready for things. Appreciate you so much tuning into the show. We're actually broadcasting live here on YouTube today and experimenting with some different forms of the show. And I appreciate you guys so much tuning in and watching. Appreciate your feedback for sure as well. Our goal is to help you understand these markets by sharing charts and observations and lessons learned all along the way. And I hope that it helps you, come up with some good decision making of your own in your own process. With that in mind, very much a risk-off day today. We have stocks rotating lower, the NASDAQ leading the way to the downside. Not much volatility, though, right? And that's one of those sort of head scratchers, right? You don't see the VIX popping up today. You actually see the VIX remaining fairly low, still below 17. I sort of, when I saw what was happening with the NASDAQ, I immediately thought, oh, the VIX might be popping above 20. It's not even moving today. So that's an interesting one, sort of a low volatility decline, a little less common. You're also going to see on the commodity side, precious metals doing just fine. Bitcoin and Ethereum not doing well, rotating to the downside. So a lot of interesting charts to review. We'll do our best to share some observations, share some signals, and hopefully encourage you to make your own process involving charts and technical analysis. All right, let's recap the markets here. Then we'll look at the heat map, see what happened at the stock and sector level. Then we'll get to some charts. We'll wrap up the show. So the S&P 500 finishing down 1%. That's 68.22. As you'll see from the heat map, for every alphabet going up, there are a bunch of things that were not doing well. By the way, I forgot to mention arguably the most important signal I'm going to show you, the Hindenburg Omen, which we've talked about here recently, firing again today. I'll show you that chart. There's been plenty of discussion on the Twitters about the different versions of the Hindenburg Omen that are floating around. So I'll share with you the version I use and why, and some of the other alternatives you might see around for sure. Having said that, that Hindenburg Omen basically implies an exhaustion to the previous bull cycle. That exhaustion certainly being reflected with today's drop. The S&P down 1%, NASDAQ Composite down 1.6%, Dow, the best of all of them, only down 0.25%. Ended up spending most of the day in the green, but by the end, the weakness in the NASDAQ dragged down the S&P and dragged down the Dow as well. Mid caps, small caps, all down. Nothing was good, but it's worth noting that the S&P large cap, mid cap, and small cap almost had identical returns. They were all down about 1%. So it's not like it was a large over small kind of thing. This was more just more of an everything down kind of thing. Definitely value over growth. If there's one way I would describe it, that's probably fair. As I mentioned earlier, the volatility was not that elevated, given the steep sell-off, if that's what we want to call it. I mean, the S&P was only down 1%, so let's not get too crazy. Although I'm tempted to put out a headline like "Stocks Plunge on Growth Weakness Through Earnings." We'll see if I can pull that off. All right, looking at the bond markets, you have interest rates generally drifting higher. The 10-year yield yesterday on Fed Day pushed up to around 405, 406. Today, continuing higher, almost at 4.1%. Did go briefly above there earlier in the day. The long bond yields around 465. 5-year point around 370, 375, about the same for the shorter end of the curve. So bond prices generally lower today. We have yields drifting higher. Not great. I mean, the 10-year yield definitely starting to shift, and that's what is sort of a number of people have asked recently about a spidey sense. I mean, my spine is tingling here at some of these signals here. The Hindenburg Omen is just part of it. The incredibly negative breadth the rates starting to turn, the dollar starting to turn is probably one of the more concerning things, right? I mean, one of the realities of the markets in 2025 has been a weaker dollar, a downtrending dollar for like the first 4 months of the year. Then the next 4 months of the year, kind of a sideways dollar. But I'll show you the chart of the US dollar in a little bit. And if you cover up the ticker and think of it as a stock, I wonder if it looks like an encouraging chart right about here. It might. It's going to look like one of those stocks you might take a nibble on. That tells you something, because if the dollar's improving from here, I don't see that as a good sign. It's nuanced in a lot of ways, but yeah, not a great sign, I would say here. I'd say that's more of a risk-off signal than anything. So rates higher, dollar higher today. We'll look at the dollar index here in a little while. Gold and silver, the GLD and the SLV up about 2 to 2.5%. The energy part of the commodity space not as good, although natural gas prices were pretty good. Crude oil basically slightly lower. I think the real story here, gold and silver kind of holding in there, a bit of a safe haven move as stocks, cryptos rotate lower, precious metals popping higher. Kind of an encouraging sign, because obviously we've been profiling the chart of gold breaking below the 21-day EMA over the last week. All red on the chart of cryptocurrencies. It's hard to be excited about the chart of Bitcoin right now. As you'll see, we're breaking below the 50-day moving average today. That's not good. I have a decent position in Bitcoin, Ethereum, and other related things. I'm starting to lighten that up this week, given the initial breakdown that we're seeing here. So again, my goal as an investor is to have a process that's not driven by my emotional reaction to what I'm seeing or hearing, but more on a rules-based, systematic, more disciplined way of interpreting changes in the charts. And when the charts change to the point that I want to start making changes to my position, that tells me something. That's probably the most important signal I get, is when something happens and I go, okay, Bitcoin's now weak enough that I at least want to take some of that bullish bet off a bit. And that's what I'm seeing with more and more days like today, Bitcoin failing to hold support. We'll look at that chart here in a little while as well. All right, looking at the 11 S&P sectors, not great, right? Weaker sector breadth. We've been talking about that a little while. The real estate sector, financial sector, and healthcare, the only three in the green. Financials up 0.3%, healthcare up 0.2%. Real estate up 0.6%, and that's your best performer. Real estate, I mean, really is a fairly sleepy, defensive, low volatility sector, higher yielding, lower vol, lower beta. I mean, a number of different things in there, but REITs generally thought of as a more stable defensive play. That's at the top of the list. What's more concerning, though, is what's at the bottom of the list. The XLY, consumer discretionary, down 2.25%. Amazon, obviously, on the earnings list this week. We'll look at that chart in a short while. Communication services, the XLC, down 1.7%. Materials, the XLB, down 1.33%, 1.3%. All right, looking at breadth, continuing to be fairly negative. We've got the advancers, decliners generally, while the S&P not bad, right? 53% down, 46% up. I mean, certainly not good, but a little more neutral. Compare that to like the New York Composite Index, about a 2-to-1 ratio, and that's similar for the rest of these. 63% down to 35% up. Now, what's happened in, as the month of October has progressed, is we've seen the indexes going higher on weaker breadth readings, and we've sort of talked about that in a number of different places. And so it's been more and more a relatively small number of stocks and a relatively small number of sectors that are really creating the upside, or at least creating the stability or the illusion of stability from our major benchmarks. Now, when you have the market moving higher on weaker breadth, as we've probably mentioned, that resolves itself in one of two ways. Either the weakness in breadth starts to drag down the performance of the benchmarks, and there's just not enough broad participation to sustain the gains in those smaller number of names, or the breadth starts to improve, which is like the best thing ever. That's when an all clear sign is launched, and the market can continue much higher. I mean, still to be determined, but right now it certainly feels like the weaker breadth conditions are weighing down on the narrow leadership. And to be honest with you, we're seeing some divergences in the narrow leadership, right? Meta gapping lower this week. is probably one of those big shots across the bow that we hadn't really seen yet. We hadn't really seen one of those big Mag 7 names get crushed earnings wise. And of course, Meta with one-off charges and all sorts of, arguably outrageously large spending on AI starts to hurt the earnings. And so that's I think what we're seeing reflected here. All right, speaking of the Magnificent Seven, here's the bad news at the bottom of the list. Meta finishing down 11% today. That's after missing earnings yesterday, gapping below all those levels of support that we talked about. We actually put out a video. It was unfortunate. We put it out before Meta reported earnings and then didn't actually promote it out. I didn't actually release the video until this morning because I'd scheduled it out and wasn't thinking straight. So there you go. And we talked about how Meta was diverging between the rest of them, right? We were talking about NVIDIA types of charts, just inconsistent uptrends. Meta starting to change. And so Meta's been in a downtrend going into this week, lower highs, lower lows, and today really getting dinged to the downside. Tesla down almost 5%. Amazon around earnings today down 3.25%. Only names that were up: Alphabet up 2.5%. That's continuing to make new highs, and Apple up about 2/3%. That's another earnings name here today. We'll go through all of those charts and more in a moment, but before we do we'll go to the heat map. As a reminder, we are live today on our YouTube channel, and again, I'm going to apologize for whipping things around on you, but I'm not going to apologize because here's the dirty secret, or I guess the honest secret. This is how my brain works. When I talk to you about discipline and the consistency and the importance of consistent routines, that is because my brain naturally is very inconsistent, and I tend to just love to move things around. And if I get too comfortable with something, if I get too bored with something, I get super bored, and then I have to change it up. So I've done the show in a certain format for a while. I have to change things up a little bit, and I might end up doing a live show again every day. But for me, kind of moving things around and just keeping it fresh is super important. And I've actually found that in my own investor routines. There's probably a broader lesson there about knowing yourself. One thing I know is if my investing routine was set 10 years ago and I did the same thing every day, I would have lost my mind well before now and would probably ended up in a different industry doing something different with my time. I often tweak things, and I tweak things sometimes because it's an important change, sometimes because I know just trying different things helps me, either feel more comfortable with the plan I've been using, or gives me an opportunity to try something new. So I appreciate you guys hanging in. If that is completely disorienting to you, I do apologize for that. Not my goal, but man, I have to be true to my own brain here. Having said that, hey, let's go to the heat map and talk about what's happening here. And we are getting questions here on our YouTube channel. So if questions come up, please pop them in, and I'll do my best to answer a question or two at the end. Not a great day, particularly with the biggest names, and that's the story here today. Starting right in the middle of the chart in the consumer discretionary sector, Amazon and Tesla both down. Amazon down 3.25%, Tesla down almost 0.5%. When you get to the next 5 names in consumer discretionary, not nearly as bad, but those 2 names have a huge impact in the XLY, and you're seeing a similar issue over here in the technology sector, where out of the top 5 names, Apple was slightly higher, but NVIDIA, Microsoft, Broadcom, and Oracle were all down. In the case of Oracle, down almost 7%. This is a pretty big risk-off day in some of those big mega cap names. Meta down 11% is obviously the biggest disruptor, given its weight in the XLC, given its weight in the QQQ, given its weight in the SPY. So I would say, again, the way that the S&P and the NASDAQ would continue higher in the consistent pattern that we've observed, in the months since the April market low, you have to have those big names doing well. If these big names struggle like they do today, and even if financials look fine and industrials look fine, you even see healthcare and consumer staples looking okay, it's not going to be nearly enough market cap to, to maintain the uptrend that we're seeing in the S&P and the NASDAQ. In that scenario, I would say the S&P would be flat to down, probably more likely down. The NASDAQ would be down quite a bit, and a bunch of individual names would do well. The good news about that sort of environment, it is an awesome time to be a stock picker as long as you're not picking those big mega cap growth stocks, right? If we're in an environment where the AI trade starts to lighten up, but a bunch of other things start to work, I would argue that's a great opportunity to flex your technical analysis muscles, use good scanning and good alerts, focus on charts that are improving and get in there. We wrote earlier today about Bank of America for CNBC Pro. So if you follow my work there as part of the Chart Investing Pro product, Bank of America is making new highs, and there are other sort of money center banks with some fairly constructive charts. The kind of chart that if you covered up the ticker, you might guess it's a semiconductor, some sort of name, because it's just been a nice, consistent uptrend. But there are charts that are working. It's just not in these some sort of major names. Now, the disaster scenario, the doomsday scenario that the Hindenburg Omen, which has again fired this week, what that brings to mind to me is the idea that all of a sudden these other names start to get dragged down. And if people start losing money in this AI trade, they're not just going to calmly rotate to other positions. They might just start panic selling and kind of selling everything. And that's where a waterfall decline, which is about as bad as it sounds, could start to play out. So what else do we see on here? I mean, other than that, I think that's the main story. As always, on a day like today, when the benchmarks were down, I would encourage you to spend some time looking at the stocks that actually weren't down, because these are the names that are fighting the broader trend and continuing to show strength. So let's not forget about charts like Cisco. They report earnings in a couple of weeks, but made a new 52-week high today. So just because a couple big tech names are down, that doesn't mean that charts like Cisco can't resume their uptrend. This is a great chart and not overextended. What's interesting is charts like NVIDIA, hard to describe them as anything but, fairly overextended with these big gaps higher, particularly like at a point like this, where they've just been in this nice big long-term uptrend. If you look at Cisco, sort of early on, right, we're just breaking above the resistance from August. This is just popping up on the new 3-month highs list, which is a scan that I run pretty often. Those are the names that I think are interesting right about now. All right, I want to get into some charts. I hope you're okay with that. Thanks for the questions coming in. I see them in here. We'll grab a couple here at the end. But let's start talking about the S&P. I mean, is the S&P in a downtrend? It is not. I mean, this is now a couple days of distribution. Today, obviously, the worst day we've seen here in about a week. Are we still in a primary uptrend? I would argue we very much is. Are the moving averages sloping upwards? They are. So is this a long-term issue? Not yet. I mean, this could turn into a much more significant period of deterioration. But for now, the S&P is still in a primary uptrend because we're making higher highs and higher lows. What I would remind you is what one of my mentors, Ralph Acampora, mentioned. In an uptrend, you don't have to worry about the highs, right? By definition, when you say we're in an uptrend, you're assuming that the trend is higher, right? You're assuming we're going to keep making new highs. The warning sign is when we stop making higher lows, because the next new high is driven by a pullback where buyers come in and provide the momentum to make the new high. And we've seen that all along the way here, right? We saw that in May when we broke above the 200-day, we pull back, buyers come in and push us above like 6,000. And then we saw that here in July and August, where we make a new high around 6,400. We pull back, we hold the line around 6,200. We make a new high, and we saw that in August and September. We saw that in September and October. So if we do get a pullback here, if this is the beginning of a pullback that goes into early November, do we keep making a higher low, which by my read means we need to hold 65.50 on a pullback. And if not, then we can talk about a big downside rotation. But until then, I see this as a primary uptrend. I am not ignoring the fact, by the way, that this pullback, if it does continue, would certainly continue this bearish divergence that we observed from mid-September to early October, now to late October, new high on weaker momentum, still kind of there. So again, I'm seeing plenty of warning signs. It's all about the trend though, right? Price is primary, as my guest, Jonathan Honig, said on the Market Misbehavior podcast this week. By the way, 2 new episodes this week for you, and actually another coming your way maybe tomorrow if I can get it out. It might be Saturday. I interviewed a couple of people at the Money Show in Orlando 2 weeks back. Alicia Levine, who's the chief equity strategist at BNY Wealth based in New York. And then Jonathan Honig is the founder of the Capitalist Pig Asset Management. Used to be a hedge fund. Now it's an advisory practice, an RIA. Jonathan, or my conversation with Jonathan, with Alicia was a lot more about macro themes really helpful for putting like the Fed meeting this week into context. So I'd encourage you to listen to Alicia's comments, particularly about other asset classes. I thought that was really helpful. With Jonathan, it was all about price action, all about following price, which was a very fantastic conversation given his start on the Chicago Board of Trade. From my experience working with former floor traders from Chicago, they have a lightning focus on price, right? Because that's how things worked in the pits. It was about price action. It was about the movements and analyzing them, which is why technical analysis is so popular there, and why my conversation with Jonathan really focused on price as primary. So I'd encourage you to check out both of those recent podcast episodes on my YouTube channel. All right, looking at the breadth, continuing to see weaker breadth. That's a trend when we're looking at the percent of stocks above their 50-day moving average. That's a trend we've been observing here for the last 4 months now. Every new high has been met by less stocks regaining their 50-day moving average. Currently down around 42%. And that's a pretty weak reading for this indicator. And the fact that it's sitting below 50% is not good, right? We're making new highs, but less than half of the S&P are above their 50-day moving average. It's just there's not many names participating, or certainly not as many that would make me feel confident on the sustainability of that upswing. Weaker breadth is one of the components into the McClellan oscillator. I already see a couple questions about this, so let's go. The Hindenburg Omen was designed in the mid-1990s, all right? And it is really was based on analysis of major market tops and looking for consistent features. Now, I will tell you, if you have questions about why I'm mentioning a signal, and maybe others may not, Tom McClellan, who I know and respect greatly, completely disagrees with the version that I will show you here. He doesn't make a secret of that. And that's totally fine. There are a number of different settings that people use. And what happens is the indicator was designed in the mid-90s. It was announced. And then over time, people tweak it and they find little improvements to it and they change the settings. I don't see that as wrong. I don't see that as a bad thing. I see that as the natural evolution of adapting indicators to what makes sense and what is, and what fits into the mosaic that that's part of your analytical process. So I've less of an issue with that than others do. So I'll explain to you how I look at the indicator and then why you might see some different comments out there. So here's the story, right? The McClellan oscillator has three main components. Number one, the market needs to be in an uptrend. Number two, you need to have a certain number of new 52-week highs and new 52-week lows on the same day. Number three, the McClellan oscillator needs to go below zero. And on my chart here, there's a little zoom in on the right. So you can see the most recent, month or so in a little more detail. So just in order, this is what the indicator is tracking. So the market needs to be in an uptrend. The way that we do this, and this is the stock charts version that I'm using, and again, there are others out there, but we're looking at the 50-day rate of change on the New York Composite Index. So today, I want to make sure that we're higher than we were 50 days ago. And as far as I know, it's pretty much what Jim Mieka, who's the guy that created this indicator, was using. And I think Tom McClellan and I agree on that one for sure. We also agree on the bottom one, which is the McClellan oscillator goes below zero. What that does is that is only going to trigger if the breadth has gone from positive to negative, right? The McClellan oscillator is measuring the slope of the advanced decline data for the New York Stock Exchange. And the McClellan oscillator goes below zero. That basically means the slope is turning lower, which indicates, a rotation in breadth. This third component is where there's quite a bit of differentiation, and different charting platforms have different settings. Different analysts have come up with different definitions for this. But here's what I use. I basically say at least 2.5% of the NYSE listings need to make a new 52-week high, and at least 2.5% need to make a new 52-week low. So what's interesting is there's things going up and there's things going down on the same day. And I think that's really the essence of what the creator of the indicator was looking for. He was looking for disagreement, right? Where there were things breaking out and things breaking down. That disagreement was a powerful sort of, I would argue, probably kind of a surprise indicator that was consistent at major tops. Now, the difference that you will hear if you look on social media is mainly usually with this. Some people use different ways of defining whether we're in an uptrend. Pretty much everyone I've ever seen uses the McClellan oscillator as it is there. This middle one is very different. I believe Jim Mieke originally used 2.8%. I've had some people use 2.2%. The version I use, which is driven by the stock charts data, uses 2.5%. So depending on what value you use, the signals are going to come more or less often, obviously, as the indicator is harder or easier to trigger. Also, just the data on new highs and new lows, what listings you're using. Is it a percent of total listings, just stocks? Like people use all sorts of different stuff. So in my opinion, it's not as consistent or cut and dry or as clear as some might want it to be. So for me, this is the version that I use. And that's why there could be some differences. So by my reading, we had an initial signal a couple weeks ago, and this would be the second signal here this week. So by my reading, that's a valid Hindenburg Omen sell signal. That's the first time we've seen it since the end of 2024. The time before then, I've highlighted those in the purple regions. The time before that was at the end of 2021 when we made a new high going into that peak. So that's the indicator, and that's the signal. So so if you have a higher threshold like 2.8%, then this week's signal was the first one, and you would be looking for another one here in the next couple weeks. By my read, we've already triggered it based on the settings that I use. That's what I'm going with. Now, here's the thing, though, and this is why I don't worry that much about it, and it's not as important to me maybe as it is to others, is because for me, I would never just start liquidating a portfolio just because the Hindenburg Omen fires. I feel like that's a little, it's not particularly a good idea because things can persist a lot longer. For example, in 2021, we actually made another new high and had another Hindenburg Omen signal at the beginning of 2022 in January before the top was confirmed. In December of 2024, we actually made new highs in January and February before we eventually ran over. So for me, the Hindenburg Omen is less a timing tool, and it's more of a big red flag that you're waving, that it says, if you're okay dealing with a little more upside, start getting defensive now, totally fine. For me, it tells me, all right, let's start focusing on a line in the sand, because at some point that is going to trigger, most likely, given the fact that what we're seeing right now is very similar to the ninth inning of other bull market phases that we've seen before. There we go. Soapbox moment over. That is my take on the Hindenburg Omen. That's what I've done with my experiences. And again, I tend to be not that broken up when people have different interpretations. I think that's what makes what we do pretty interesting. So that's my view on the world and on the Hindenburg Omen indicator. Again, by my take, showing a sell signal here this week. All right, speaking of things starting to break down, Bitcoin also in there. This is zoomed in to the chart of Bitcoin going back over the last, looking at the last 4 months here. And what I want to highlight is the fact that this shaded area has been sort of our support zone for a while. We actually focused in on that after we broke out above these levels back here. And going into the late summer, into the fall, we started to make new highs, got to around 123,000 or something. Then we saw some pullbacks, and we eventually got down back to that shaded area. And every time we confirm this region as an area of support, for me, it becomes more and more valid. But it also means that if we eventually break below there, that is a major league danger sign. Today's drop, where we're currently trading around 107,000, is getting below the 50-day moving average. We did, the 200-day moving average here in red, I meant to say. So in mid-October, we actually traded below the 200-day a number of about a week and a half. We closed below it a couple times, but kept bouncing off. Well, those pushes below the 200-day actually saw a bit of a pop higher. And we'll see if that sort of thing happens again, based on what I'm seeing with this break of the 200-day. Assuming we get some sort of confirmation tomorrow, I'll probably start lightening up some Bitcoin-related positions just to protect myself from something way more significant happening to the downside, which is certainly a possibility. Breaking below the 200-day has not happened often, and if that would happen, I would be happy patiently waiting for a break back above the 200-day moving average as a sign that things were getting a lot more positive. Now, the lower end of this range is where I'd probably get pretty negative, and that's below 104,000. That would clear the support area and also clear the first Fibonacci retracement. If we look at the April low, to the July peak, which I would say is the most recent significant peak, we're kind of right at that point. But the fact that we are where we are, the fact that we're breaking below the 200-day tells me to start to lighten up a bit, just to be safe. And if we would see further deterioration, if we would break below 104,000, that's where I would start to get a lot more. Note for sure the momentum, right? If the RSI pushes below 40 going into the weekend, that would be a particularly bearish development. Now, the ideal situation for gold is after this brief breakdown below the 21-day EMA, we start to show signs of accumulation and pop back higher. We appear to be seeing a bit of that here. Now, part of that is a bit of a safe haven move with today, with equities rolling over, with the mega cap names struggling a lot more than they have. Gold has already pulled back quite a bit. This is the GLD we're looking at, closed just above 400 about 2 weeks ago, got down to around 360, now trading back up to around 370. So getting back above the 21-day EMA, for me, pretty encouraging sign. The fact that the RSI may be holding 40, I would argue, is very encouraging, because pullbacks are normal, even in a bullish phase. As long as the RSI holds 40, you can still determine that that's a constructive long-term trend. So we'll see if that will continue. All right, here's the chart of the dollar. Now, I've already, I'm into the mystery chart thing where I covered up the ticker, but ignore the fact that this is the dollar and just look at the chart. Is this the kind of chart you might take a shot at, right? If this was a stock, this was like an industrial name or a healthcare name, you've been avoiding the sector, but all of a sudden you start to see charts like this, making a clear double bottom pattern, breaking above the 50-day, testing that as support, rotating higher, RSI sitting above 50. I mean, not a bad chart, right? I mean, it's not the most perfect chart I've ever seen, but it's not bad. Pretty close to breaking to a new 3-month high, which for me is a pretty encouraging sign. But this is the US dollar. And I would say the fact that the dollar's been so weak for most of this year has been one of the great tailwinds to a couple different things. Number one, that weaker dollar is really good for big multinational companies like Apple types of companies that bring in a lot of revenues outside the US, because those awesome revenues outside the US, when converted back to a weaker dollar, are even more valuable. Now, that tailwind becomes a major headwind if you see the dollar trending higher. And if Apple's non-US revenues all of a sudden are being converted back to a stronger dollar, those non-US revenues are much less awesome in dollar terms, and they report their earnings in dollars, right? That's how they're measuring things. So weaker dollar, pretty good for US multinationals. Stronger dollar, pretty bad for US multinationals. On the other side of that, probably better for small caps, because they don't have a lot of revenues outside the US, and so they're sort of immune to that dollar strength challenge. So, is that something that could contribute to small caps outperforming? Perhaps. I think you would need to see more sector rotation into some of those value-oriented sectors that are more heavily weighted in the small cap space. But for now, that's something to keep in mind. I would say stronger dollar at this point sort of would be a risk-off kind of signal. I do want to point out, by the way, before we get too excited about the relationship between the dollar and stocks, I always caution people when they say, all right, stronger dollar means stocks go down, or whatever relationship that is. Those intermarket relationships are not as stable as you think they are. Even ones that seem so obvious, they really are not. And this is the 20-day rolling correlation of the US dollar and the S&P 500. So we can see generally, is there a negative correlation? A lot of times there is, but you'll see a lot of times where actually the dollar and stocks actually are relatively highly correlated, positively correlated to one another. There are times when it's right in the middle and there's essentially no strong relationship between the two. So again, I tend to think of these sorts of things as tailwinds or headwinds, and less as absolutes, right? Because remember that the markets are a complex system. A lot of things can contribute to a lot of things on those charts. All right, to finish off, growth sectors, technology, even with the pullback that we're seeing a bit today, the technology sector has been by far the best sector in the last 2 months, coming from the end of August to the end of October. It's been technology, and then a big step down to anything and everything else, particularly the other growth sectors. This is the relative performance of tech versus the SPY. Look at the uptrend that we've seen in relative performance since the beginning of September. Look from mid-September to end of October, communication services very much underperforming, The same can be said for consumer discretionary, the XLY. So, it's not a growth story. It's a technology story, as we highlighted on yesterday's show. We showed it, the SPXT and some of those different ETFs that can help you understand a little bit more about leadership trends. But, again, all growth is not great right now. All right, some earnings to debrief on. I mean, in terms of concerning charts, is Microsoft breaking down? No. But is it still going up? No. I mean, no, right? I mean, it's sideways. And if we do end up getting a major sell-off from here, I think the chart of Microsoft and this just clear double topping pattern may be the chart that tells the story of this current environment. A top can occur when you have a stock that tries to make new highs and fails to do so. And that's what we're sort of seeing here with Microsoft. Gapped higher on Tuesday, Wednesday, Thursday, rolling over. So from that earnings report to where we're at today at the close, not a lot of buyers coming in, rotating lower here. Alphabet, the best of all the Magnificent Seven stocks today, actually closing higher about 2.5%, but it opened up here around 292. By the close, we're down around 282. So we closed near the lows of the day. Is that a horrible chart? No. It made a new all-time high today, but were there a bunch of new buyers coming in thrilled to own Alphabet now that it's way more expensive? I did not get that feel. I got people selling into that open. The opening price was the high of the day, closed lower. So it feels more like an exhaustion gap kind of thing, which is an uptrend. And then you have one big gap higher before things start to rotate lower. And it hasn't broken down yet. I think that's something to monitor here tomorrow into early next week, but something to be concerned about. Meta, of course, a big story today, right? So the danger with earnings, we talked about this going into this week with our premium members. The danger to this market is while big, growthy earnings, if they go well, that's just going to be additional fuel to the fire. But if any of these companies miss, they're going to get crushed because this market is being fueled by optimism, let's say euphoria about the continued strength of these names. The challenge I have seen is that companies like Meta are spending an absolutely insane amount of money on AI and building up that AI-related infrastructure. Not all of them are going to end up leading in that game, and Meta generally seen as lagging behind others in some of those areas for sure, and earnings biting it pretty good. Today's gap lower takes us below the first Fibonacci retracement level, also takes us below the 200-day moving average. So the reality is, and this is what we talked about on our most recent YouTube video, is the fact that the trend has been down now for a little while. We've been making lower highs and lower lows going back to mid-August. And that's different than some of the other Magnificent Seven names that haven't really seen that sort of clear downtrend move. So today's gap lower kind of takes us below the channel here, takes us below that level. So in the short term, getting back above 675 and taking out this level, I think that previous support becomes resistance. And that's what I would be looking for sure. And until that happens, this is the kind of name I would be staying away from personally, although I don't have a position in Meta at the moment. RSI stalled out at 60, by the way, as the stock tested 760. All right, we've got more earnings today, and we only hit on a couple in our show, but there's a bunch, obviously, of S&P 500 names. I think it was like 20% of the S&P reporting earnings this week. So it's quite a few. So I'd encourage you to go through those charts, of course. But let's look at Amazon. So Amazon down about 3.25% today. Did close briefly below its 50-day moving average at the close. Let's look at what's happening after the close. Amazon up good. Look at that. Up 13%, about $29 to $252-ish. So currently trading up here. So if that's what happens, talk about the complete counterweight to Meta. Meta gapping lower. Amazon looks like it's gapping higher with an earnings beat. Getting above 240, 235, right? Clearing that range is the most bullish sign. The weekly chart of Amazon is even better, right? Because that's going back to these highs, right? 240 has been the ceiling from January and then retested here in the last 6 months. Break above there would be a huge win. It looks like a nice upside breakout for Amazon. That could save things on Friday here. Apple, by the way, also trending higher, up about 2/3%. Let's see what's going on here. Up 3.5% in the after hours, up to around 281. So we're trading up here in the full quote line on stock chart. So one of the largest companies, 4 trillion market cap, continue to go higher. So what to watch on charts like Amazon and Apple? It looks like they had a decent earnings win. I haven't looked at the reports in any detail now. Looks like the stocks are going to be higher tomorrow. Look for the Alphabet pattern, right? Alphabet gapped higher and then traded lower. That's a sign that they beat earnings, but investors are just not looking to take a lot of risks. And what happens when investors get nervous is when you have an earnings beat, you open higher, but everyone kind of sells out because they're like, all right, thank God, at least I can cash out of a winner and at least get something good out of this horrible week. And that's what causes charts like Alphabet to play out. So I'd be very keen tomorrow to see if some of these earnings wins actually maintain that breakout or if they roll over. Last chart of the day, then I'll take maybe a question. Bank of America, BAC. I like the chart of Bank of America. I like the chart of a number of financials that are a little early on in their uptrends. We think about overextended moves in technology and other growth areas. Financials, in a lot of ways, not as overextended. I see Bank of America as sort of having a breakout here in August above a bull flag pattern. I would say this week potentially breaking out above resistance as well. Sustaining a move above 53, ideally with improved momentum. This is the chicken money flow. When you have a big breakout like that, it's good when you have improving volume, because that suggests that there's lots of buyers coming in and pushing price higher. So I think breaking out a 53 with improving volume, meaning the chicken money flow gets above zero, that would be a perfect storm right about there. All right. Let's take a question. Getting some great feedback on the show. I appreciate you guys so much for throwing some in there. Let's see. 3P Investor, as always, thanks for being a longtime viewer and for your feedback. So John Murphy's intermarket analysis is no longer valid. I could not talk negatively about the great John Murphy and his foundational work on intermarket analysis. No, and I tell you what, John wrote a number of books that refer to intermarket analysis. I'm a huge fan of those, and those books were the first time I really started to appreciate that when I was studying for the CMT exams back in the mid 2000s. I ate up those discussions about intermarket analysis, really helped me to understand how these things are related. Now, what John will tell you, right? And I'm trying to think, because there are a couple different versions of that book. I think it's called Trading with Intermarket Analysis. There are a couple versions of that book. And if I remember right, in later version than the last version I remember, he did talk about it. I think there's an add-on, like an appendix, where he talked about how those relationships had changed. I remember my first impression when I first read that book was that, all right, this is easy. I remember drawing like a simple flow chart on a piece of paper and being like, all right, if the dollar's up, that means commodities are down. And if commodities are down, that means bonds are up. And if bonds are up, that means rates are down. If rates are down, that means stocks are up. And I just had to remember that simple relationship. But in his later writings and then other conversations with people like Bob Prechter have done a fantastic job over their careers highlighting how those relationships are actually quite fluid. So in the book we're talking about, by the way, if you just joined, Trading with Intermarket Analysis by John Murphy. I was asked if that's still a legitimate book. And so I would say, yeah, the latest edition, the last edition of his book that I remember reading, he talked about an updated, set of relationships, how they're actually fluid, and that's part of the story. And it has a lot to deal with whether we're in an inflationary environment or deflationary environment. I would also encourage you to read stuff by Bob Prechter, who talks about how those relationships are not particularly stable. So if you throw anything at him, like when gold goes down, stocks go up, he'll show you a bunch of examples where the complete opposite happens. So if you recognize that they are just one relationship among many, I still think it's super important to be aware of and understand them. But I always tell people, think of them in terms of headwinds and tailwinds and not in terms of absolutes. If the dollar's stronger, that means it should be good for XYZ. It should be bad for ABC. But I also want to continue to monitor the trends. And that's why analyzing the trends, analyzing the price, more important than anything. Folks, that'll do it. Thanks so much for joining me on the show today. Thanks for you, those of you turning in live on our YouTube channel. I will continue to twist things around as I need, but I appreciate you tuning in. I hope my comments and charts made you think, help you to understand the benefits of charting and technical analysis, and give you some ideas for how to approach the markets tomorrow. For now, I'll say have a fantastic evening. And remember, it's always a good time to own good charts. Take care, folks.